Hello and welcome to Outlook Money's Investment Made Easy podcast series. This episode is spearheaded by ICICI Prudential Asset Management Limited. The contents of the discussion should not be construed as Outlook Money's editorial recommendation. I'm Versha Jain from Outlook Money and your host for this session. Welcome to another enlightening episode of the Outlook Money podcast series, where we break down the complexities of the financial world and give you insights that can potentially make a difference to your financial well-being. Today's episode is brought to you in association with ICICI Prudential Asset Management Company Limited under their Investor Awareness Program initiative. Our topic for discussion today is things to keep in mind while investing in passive. Over the past few years, passive investing has gained immense popularity, with many advising it as a simple and cost-effective approach to building wealth. But what is passive investing? How does it differ from active investing? And more importantly, when should you consider this investment strategy? To answer these and many more such questions, we are joined by a very special guest, Mr. Chintan Haria, Head of Investment Strategy at ICICI Prudential AMC. Welcome, sir, to this episode.
So much, Varsha, and thank you, Outlook Money, for always allowing these discussions with the investors so that they are aware of the latest investing trends, and we are trying our best in terms of this series to explain whatever is the available option, and more importantly, make it simplified in terms of the understanding of the various products that are. Thank you.
Absolutely, to simplify it. So without much further ado, let's dive right in. To start off, Mr. Haria, can you explain to our listener what exactly is passive investing?
If we look at available options for investors to invest, typically we speak of asset classes like equity, debt, real estate, commodities, gold. Within equities, there are mutual funds which are there. And within mutual funds, so in equities, you can directly go and buy a share of the particular underlying stocks. And there are thousands of stocks listed in India. Or you can invest in mutual funds, which are basically a group of stocks or a selection of stocks of 30, 40 stocks, which are there, based on either an active fund manager managing the fund or a passive fund. Now, that's where mutual fund can be an active mutual fund or a passive mutual fund. Most investors are aware of what active mutual funds would be because that's the more popular part of our mutual fund category. I think mutual funds today account for about 27 lakh crores of corpus, out of which 22 lakh crores or 23 lakh crores is active. About 3.5 to 4 lakh crore is passive in mutual funds. So active mutual funds, of course, are mutual funds which are managed actively, as the name suggests, by fund managers. Fund managers, based on the scheme's objective, manage the active funds by selecting a group of stocks from various sectors and with various weightages, create a portfolio which in the long run tries to basically manage risk and give returns to the investor. Now, on the other hand, passive funds are essentially those funds which do not have an active fund manager managing the fund. Passive funds, as the name suggests, are replicating a particular predefined underlying benchmark index. So the benchmark index, in terms of its methodology, in terms of its name, in terms of its constituents, in terms of its universe, in terms of its weightages, everything is defined in a predefined methodology. And based on that methodology, the index provider comes out with the passive index on a daily basis, which the asset management company or the passive mutual fund replicates and allows investors to participate in the particular index through the passive mutual fund. So, passive mutual fund, there is no active fund management involved. It's basically a replication of the underlying benchmark. And that is the reason why passive funds are cheaper than active funds because they do not involve an active fund manager making the choices. And to that extent, because they are replicating an already predefined benchmark index, they are much cheaper than an active fund. So, among the major differences between active and passive, these are the major differences. And from an investor standpoint, we always say that it is never active versus passive, but active and passive both have a place in an investor's portfolio for long-term wealth creation by investing in equities, Within passive, of course, there are other options also of passive debt funds and passive commodity funds like gold and silver ETFs available in passive. We'll speak about that as we move along. Thank you.
Very beautifully explained. So it is the replica of some standard benchmark, or we can say the mirror image of the index. So when we talk about passive investment, are these only index funds or ETFs? Or are there other options as well, which we can call passive investments?
Sure. So again, much like how within equities you have investments in equities possible directly on the stock exchange, and you have mutual funds. Within mutual funds, you have active and passive. Within passive, you have index funds and ETFs. Now, index funds are essentially similar to mutual funds, wherein an investor investing in an index fund or removing money or redeeming money from an index fund will get the day end NAV as the price of unit subscription and unit redemption. So essentially, index funds are similar to mutual funds, wherein the subscription and redemption happen at the day end NAV. On the other hand, ETFs are simplify it. ETFs are nothing but index funds which are listed on the stock exchange. And ETFs, as an underlying, are following an index benchmark. The only difference between index funds and ETFs is that ETFs are traded on the exchange. So if an investor at the live market during the day wants to invest in an ETF, they can go on the exchange. And much like how they are buying and selling individual scripts and stocks, they can buy the ETF from the exchange at the price which is basically determined by the live market prices of the underlying stock. So there is a active price discovery mechanism of ETFs as a portfolio level happening, and which is reflected on the stock exchanges as and when the price changes happen. And that's basically what creates the ETFs or makes the ETFs a very good tool for investors to take advantages of any major market dislocation. If the markets have fallen sharply, let's say intraday, and they're down 4 to 5%, the investors can take advantage of that by getting that or buying at that price, because it's at the live prices that the ETFs are traded. Thank you.
So according to you, out of these two options, ETF and index funds, ETF is a better option because there is the live price mechanism, and in case of any extreme down or up in the market, one can take advantage of it.
So there's not much of a distinction between index funds and ETF from a long-term perspective, but it all depends on the investors' likings and investors' ability to basically trade. Some investors prefer the ETF route because it's easier to trade in unit form, and some investors like the fact that they are getting it at market price. While some investors who do SIP investments, they prefer the index fund route, or who do not want to trade on the exchange or cannot trade on the exchange for some compliance or regulatory reason, they prefer the index fund. So both are good mediums as we see it in terms of long-term wealth creation. It depends on the comfort of the individual investor, whether they go the index fund route or ETF route. But yes, like you rightly mentioned, if an investor wants to take advantage of the real time, let's say there was a time in 2006 or 7 where I think 2004, I think, where the markets hit a lower circuit. If the investor wanted to take advantage of that, and then wanted to buy ETFs at that time, then yes, they do get an advantage of the price discovery, which is live. But in the long run, it won't make too much of a difference whether you invest in an index fund or ETFs, as we see it. Thank you.
Thank you very much for clarifying this for our listeners. Now, please tell us under what circumstances should an investor choose passive funds for investment, or is it suitable for everyone?
So I think both active and passive are suitable for all kinds of investors. It ultimately depends on the investor's knowledge level, skill level, and how or who is advising the investor for their investment journey. Typically, we are seeing ETFs and index funds being low cost. The advisory route, which essentially looks at the low cost products from a client portfolio perspective, is a route through which we see more investors coming into the ETF and index funds. Also, family offices or cost conscious investors who want a low cost alternative of participating in equity markets in diversified portfolios are taking the help of ETFs and index funds. especially today at a time where there are so many alternatives available in ETFs and index funds, be it market cap weighted, be it sectoral, be it thematic, be it smart beta such as low vol, momentum, quality, value. Opportunity set is so wide that many investors and family offices are finding it easy to create an entire portfolio out of passive funds, and hence we are seeing an increase in passive funds as a concept, and investor awareness is increasing. But I would say that between active and passive, both are suitable for all kinds of investors, because ultimately what is important is to get investors invested in equity markets. And I think both active and passive equity funds are trying to do just that. And the more mature or the more aware an investor is, the more we see them moving towards ETFs and index funds at times. Thank you.
So what I have understood is that passive funds, because they keep something as a standard, so it is better for the risk averse investors. So
So
is it a good investment for people who seek security? For example, senior citizens. So for them, passive investment is a better option or the active investment?
so I would say that both active and passive ultimately are giving an exposure to equity markets depending on which category and which underlying the investor selects. So, whether it is suitable for a retired individual, whether it's suitable for a person who's starting their journey of investment as a first job or earlier than that, it all depends on which underlying category you select. The risk levels, be it active or passive, are not going to be meaningfully different. For example, if you invest in a large cap fund which is actively managed, and if you invest in a large cap index fund or ETF, the risk and reward may not be too different over a longer period of time, and the risk of equity remains there. So, if an investor is looking at from a risk diversification perspective, then they should look at diversification of underlying investments, be it in active or passive. Passive is not risk-free. ETFs are not risk-free, but they are participating in markets. They are investing in equity markets or commodities or debt. And in the long run, much like how an actively managed fund would, the passively managed ETFs and index funds also try to participate in, or they do participate in the markets. And based on the market returns, you will get basically the returns in your investments in ETFs and index funds. So, one who's retired, don't think that ETF investing is risk free. That's not how it is. ETFs are also equity investments. The only thing is they are low cost, and you as an investor know exactly what is the methodology and the stock selection that is going to happen in an ETF. So you can plan your overall portfolio that much better, because you'll have absolute clarity of what your investment is going to bring to you in terms of the stocks or the sectors and their weightage selection based on the methodology. In an actively managed fund, there are times when the fund manager can take extreme calls also in the interest of investor, which may or may not work out. So you cannot be sure, but in a passive fund, you can be sure of what you actually will get based on the methodology. Thank you.
Okay, now coming to another crucial point, what factors should one consider to select a suitable passive fund?
Well, Indian context, of course, there are very few passive ETF index fund providers. That number is increasing with a lot of digital ETF or index fund providers coming into the foray. But historically, if you look at it, there were only two or three serious players, or three or four serious players on the ETF business. But what are the main key factors that you should keep in mind when you're investing in an ETF? The first and foremost factor, of course, is cost. Because if you look at from a ETF perspective, the lower the cost, straight the benefit of the investor. However, is cost the only factor? The answer is no, because how efficiently is the ETF managed in terms of its replication to the underlying portfolio is also very important. This, in technical terms, is called tracking error. In other words, how efficiently is the fund, which is the ETF, being able to replicate the underlying portfolio so as to give returns which are similar to the underlying portfolio. If the team which manages the ETF is not capable or is not able to have processes in place which are helping them replicate the underlying index and the returns get deviated, that can be a hit to the investors. So, point being, apart from low cost, the tracking error should also be low, which essentially means that the replication of the index and the ETF should be well synchronized. Apart from that, if we look at it from a ETF provider perspective, the liquidity on the exchange or the spread on the exchange also matters a lot. Most fund managers would keep, most asset management companies have authorized participants who are providing two-way quotes on the exchange so that you have enough liquidity on the exchange for execution of trades. Arguably, in India, some of the ETFs and the mechanism of authorized participants or liquidity is not the strongest yet. But with more and more people getting, or more and more investors getting into the ETF investing, we do believe that over a period of time, the liquidity constraints which are being currently faced would also go away. So, to summarize, cost of the ETF, lower the better. Tracking error of the ETF, which is essentially the ability of the ETF to track the underlying index. Lower the tracking error, the better. And from a liquidity on the exchange perspective or the spreads on the exchange perspective, if is the ETF trading on the exchange at a price which is similar to the on-ground indicative NAV, which is the real-time prices. So these are the three things which are majorly to be taken care of. Most of the asset management companies are anyways focusing on ensuring these three are probably in sync with the investor. And the last part, while these are the technical parts of ETFs factors which are taken, the actual and the most important aspect is the fact that is the underlying ETF suitable for your overall portfolio based on your risk requirements. So if you don't have ability to take equity risk, and if you end up taking a portfolio of small cap, mid cap ETF or index funds, it may not serve you well in the long run if the markets fall and the small caps and mid caps fall. So you need to be sure that whatever category you are picking up, it suits your investment requirement. And then the other three factors which I mentioned of tracking error, cost, and the liquidity should be kept in mind. Thank you.
Thank you so much for very crisply describing it. Three factors now: cost, tracking error, and liquidity are the most important criteria to select a passive fund. And besides that, the most important factor is the requirement, investment requirement of a person. Just a small query here, that is there any acceptable tracking error?
Yeah, so if you look at generally the tracking errors are inclusive of the cost or the total expense ratio. But in general, anything which is below half a percentage or 0.5% tracking error is acceptable, which essentially means while the from a regulatory standpoint, anything below 2 is considered or is not required to be reported. But if we look at from a practical standpoint, anything which is below 0.5% is something which we should consider it to be a good tracking error. And most AMCs are working towards lowering their tracking errors and having their processes in place. I don't think investors need to worry too much about these smaller technical factors in their overall choice or investment. Thank you.
Is there any right time to invest, to consider investing in passive mutual funds, or any time is a good time?
So I think from a investor standpoint, the right and the wrong depends on what they are selecting and the time horizon that they have. So clearly, looking at past returns, if you're investing, that may not be the right thing to do. But if your investment horizon is in the long run, and if you are investing in a manner which is creating a well-balanced overall portfolio, I don't think you need to be worried about the timing. But yes, I'd like to highlight that if you are picking up themes and sectors and say mid caps and small caps and typically the high risk segments, you need to probably be worried if you are investing at the time where they've already done too well. So from an investor standpoint, there is no right time or wrong time. It depends on how long an investment horizon you have. and also what is your overall portfolio allocation. So I think you need to keep that in mind. And again, I'll reiterate that in India, the importance of advisors and relationship managers is basically not, let's say, it's not given due importance, but it's very important in the world of finance to have the right person to guide you, create an overall portfolio. So please make note of that and try and have the right person advising you on your financial investments. Thank you.
All right. And so the importance of a right person is very important. And finally, the question is that for our avid SIP believers, please suggest, is SIP a recommendable route for passive investment, or should one go through it through lump sum investments only?
So again, this depends on the investor. They can, in the case of ETF, there's a concept called as SEP, which is stock equity, basically systematic equity processing, which is essentially you can do a monthly SEP in the case of or a weekly SEP, depending on whatever the broker platform allows. You can do lump sum as well as systematic investing in ETFs also, in index funds also. You can do that. It again depends on what is it that fits your profile and what do you need. So both the options are available, both options you can do. We always prefer that if an investor has chosen a set of ETFs or index funds, if you invest via the SIP route for the long term, which is 5 years, 7 years, 10 years, 15 years, you see the full benefit of that accruing to the investor, and the investor will basically see the impact of compounding and wealth creation over a long period of time, which is exactly what we wish all investors get to participate in the long-term growth story of India. Thank you.
Thank you so much. That's been immensely insightful, Mr. Haria. And I'm sure our listeners will also find this discussion beneficial. Thank you again for joining us today.
Thanks a lot. Thank you.
Thank you, Mr. Haria, and thank you, our wonderful listeners, for joining us today. With this, we come to the end of today's episode of Investment Made Easy podcast. Listeners, we hope you enjoyed our conversation today. To dive deeper into investments realms, stay tuned to Outlook Money's podcast series. Don't forget to like, share, and subscribe to stay financially informed. You can also share your suggestions and questions at letters@outlookmoney.com. And until next time, stay informed and keep following Outlook Money, your favorite personal finance magazine.